the yellow shaded area here, that says the entire daily volume imbalance. If you notice, this level here, the 20,001, that is the rejection block from the daily chart. This is the full daily volume imbalance. This is our new day opening gap for today. You see the reference points over here. So it's tapping that rejection block. Now, if you look at what we have here, this is my daily volume imbalance. This is the one I was using. If you look in the lower right-hand corner, you'll see SET. It changes the volume imbalance. I'm looking for PV arrays, whether I'm using the settlement price toggled on or off. So if there's a fair value gap, one toggle of settlement used or not used, and it's broader and wider, I'm going to elect to use the wider one. I'm not trying to get the smaller one. I'm going to use the wider one. When we traded up to this candlestick right there, remember, this is what I said. Well, we went up to this part and we had that remaining portion left. And then it traded through it. But volume imbalances are what? Inefficiencies. And inefficiencies are gaps. Gaps are not one and done, filled and forgotten. The idea of toggling back and forth, I see this rejection block. But the same thing, I want to see where does that candle body go if I toggle it off. And that's why that's my rejection block. Because it's the one that's further away. Further away from where, ICT? When it's down here and I'm reaching up for them, these are premium arrays. When price was below this volume imbalance like that, and we're below it down here, that's a premium array. We want to see it dig into that. Now, we have continuously pressed in, and I told you that it's not likely to be sustained having this many days up without a down closed candle. So it's unsustainable. And that's why we had this singular down closed candle, which is good. You want to see that, and you want to see, does price respect that? It trades above it, yes. And today we opened, traded down into that candle, and then rallied back up. Where is it reaching into? The rejection block. So we're getting ready to trade into the midpoint of this wick. So there is consequent encroachment on that premium wick. So if we trade to this, above it, and come back down and treat it as support, so now we're in the opening range. Opening range gap is this. There's your gap. That is midpoint of the wick on the daily chart. It does not need to trade there. But we have a gap here. So this is the highest probable location. When you have a gap, the first thing in my mind is, do we have the ability for price to reprice to half of the gap? This is where we closed at yesterday's settlement price using day session hours. That price here is the low of the opening range gap. The first print at 9:30, that's your opening tick on this candle right here. That is the high. But the opening range, which is the first 30 minutes, that is a dynamic range. It can expand throughout the entirety of that 30-minute time frame, meaning right now the highest high is here. So it's this. All right. And this is the lowest value right now. So this is what you're doing every single day. You're monitoring and watching from where we open, what is the highest high and the lowest low that forms until 10 o'clock. The opening range is we're watching, do we have a fair value gap form? So inefficiency. The very first fair value gap that forms after 9:30 in this first 30 minutes interval, it is such a wonderful secret weapon. This is our opening range. It's a time period that begins at 9:30 and it goes up to 10 o'clock. That is the real opening range. So what your interest is you want to see what this dynamic range in time is doing. What's the highest high and the lowest low? And the first fair value gap that forms in this first 30 minutes, you want to extend that throughout the entirety of the day, all the way until 3:45. You'll be surprised how often amazing trades will form off that first fair value gap. So right now, this is the lowest low. We want to see, does it expand down through it? The first probable level is that midpoint of the gap. And that gap is the opening range gap. You're always hunting, and I'm looking for it through not just the 1 minute chart, but the 15 second, the 30 second, the 45 second chart. I'm watching that as well. Generally, when I'm actively trying to take a trade, I'm looking at 15 to 5, the 1 minute, and then I have that matrix that has all of the 5, 4, 3, 2, 1. And then I have a 45-second chart, a 30-second chart, and a 15-second chart. And I'm looking for the first fair value gap that forms in those time frames if I have a bias. So right away, I want you to think, I've said it before, it's not a panacea. It doesn't mean it's going to work every single time. But whenever you have a gap up, which is where what we have here, we have yesterday's settlement price, and you determine that by going into regular trading hours. That's that price right there, okay? And you annotate it, and you annotate the first tick opening price. That is your opening range gap. Now, when it gaps up like that, you want to find the midpoint of that because many, many times you're going to see it trade to that level. It may afford you a setup. If there is a setup that yields a run from, say, maneuvering something up here off of a premium rate and starts to break down, and you get a fair value gap, say on a 15-second chart or 30-second chart or 45-second chart or the 1 minute, and it affords you a range from wherever that gap is to the midpoint of the gap, that could be your very first like training wheels. So what are you doing in the first 30 minutes? Well, if you don't know how to trade, you should be studying, observing what price is doing, because you don't know what you're looking for. So what can you do with that 30 minutes of time while not knowing how to trade? You study it. You look for the very first inefficiency, the very first fair value gap that forms in that 30 minutes. It's the focal point for the daily range. Until we enter a trending day, that fair value gap can be used multiple times for multiple trades, both directions. But the mid part of that gap, whether it's an up gap, okay, so this is a premium gap. Why? Because we gapped higher than where we settled. So this is a premium opening range gap. If we gap lower than the previous day's settlement, and we say we open down here, that is a discount opening range gap. Okay, very simple. Same thing, as soon as you get the first ticket, 930, you want to throw a fib on that just to get the midpoint. The midpoint has a 70% chance that mid gap level is going to get hit. Now, that doesn't mean that you're going to get a 70% chance of getting an entry that's profitable, that never got stopped out, that never had drawdown. It doesn't mean that. What I'm saying is 70% of the time from the opening price to 10 o'clock, that level gets hit 70% of the time. It can go all the way back down and fill in the gap. Another instance is when you have this measurement like this and you know where you have the higher gap opening and we're in a premium gap. You want to measure where your quadrants are. Many times you'll see it go down and leave a smaller portion of the gap opening, which is really what I love seeing that. Say we're bullish and we think price is going to go higher. What happens if it doesn't go down and touch the midpoint of the gap? It means it's really, really bullish. The examples I've shown where I've entered in before 10 o'clock, it's using this logic. And then I'll have a runner that would hopefully probe any movement below the midpoint of the gap to see if I can get down to the lower quadrant. And then all of a sudden you'll see that's where my other partial was taken. And if I get a gap closure, I'm going to be a little bit higher than the full gap closure, because it can do what? In a perfect world, you want to leave a small portion of it open, because every gap invite the opportunity that it doesn't completely close in or fill in. That's my main focus so far when I've been teaching gaps in this 2024, is you don't want to see them completely fill in, because that's rocket fuel. One more time. So where we opened down here, 70% of the time. Now, this is the old high of that volume imbalance. Watch that level as well. That's why it's there. There we go. There's the top of the volume imbalance it traded to. So if you didn't want to take a partial at the halfway point of the gap, that could be hitting it right there. Boom, that's your partial, because you want to see it get below the opening range gap half if that's your model. We're sitting at the top of the opening range. Now what we like to do is, since we hit half of the gap, it's come down there, and then now we're at the top of the gap. Do we have the wherewithal to trade above initial high of the day? And if we do, where can it go? That's what that midpoint, halfway point of the gap that we outlined as that wick on the daily chart. If we take out the opening range high again and close, if we close above it, anytime that we go below here opens the stage to come all the way back down to a full gap closure. Otherwise, I'm not interested in going short. It would need to do that. So it has to go below here. Okay, so that's the opening range low, and whatever the highest high is, that's your opening range for the day. And you want to do quadrants on that and extend that throughout the entirety of the day. And if you have a macro overlap with that, with time, chances are you have a trade, as long as you know what side of the liquidity you're going to aim for. And I just gave you something that I've never taught that anywhere. So we went above, and now right below this low, we have initial sell side and buy side is here. So there's inefficiency between the low of the opening range. We have sell side here and inefficiency down to previous settlement. So this part is the remaining portion that's lacking any buying and selling during the regular hours. It doesn't matter that we traded here in electronic trading. Always give the opportunity for the day session to reprice into this area. Both sides. Since there's no trading between the settlement price and this candle's low, there's no buying and selling booked at all. Now, I'm not saying there hasn't been, because clearly if we go to electronic trading, you can see that we did trade through it. It's lacking what? Sell side. Since we passed up through it here, it's lacking sell side. So what kind of price delivery, if it wants to go back to the settlement of yesterday, if it goes below this low, what type of price action would you like to see? If it were to go below this low, knowing that we have absolutely traded to the upside through it, so we offered what? Buy side. It's missing what? Sell side. So if it can manage to go below that, would you expect it to go below it a little bit and then shoot right back up real high? Or would you want to see it go below it and drift real slow and lethargic down to the previous settlement price? Or would you expect it to be, boom, 1 or 2 candles and get down to the previous settlement price? I would expect it to be quick and sudden to fill the gap. It provides a means of classification on how price should deliver, not that this is where it could go. Well, that's one part of it. That's one part of the equation. But then you have to have elements of time. How fast should a price run? How should a price run deliver? Should it be sudden, real quick? Or should it be lethargic and choppy and back and forth, lots of retracements? Or is it trying to get down there real quick? Now, I would expect if it were to trade below that low to do it quickly. And what else is inside that area? That's today's new day opening gap. So we have a new day opening gap towards the low of the opening range gap and the remaining portion here. So we have to watch this low. What happens if it does this? Say it trades down below and starts to come back up a little bit. What is it doing? Well, it could be taking this wick right here, finding the midpoint of it, hit that, and then expand lower, like a sudden rush to get down there. We have moved to the midpoint of that daily volume imbalance. That's that shaded area here. Now, we traded up to the bottom of the opening range gap. That's the opening range gap low. If you remember, I gave you the lay of the land for the daily chart. Without me saying anything, what do you see in price action? What was offered as a premium array? Where did price repel from and move lower? And where did it go? That level right there, the 20,001 level. That's the rejection block, okay? And I have this little line here that explained to you why it was there. And also you understand that a rejection block can be used as a reversal pattern. That means if we have a high here and we're expecting prices to do what? Gravitate where? Well, we have an opening range gap. So if it can trade to fill the gap, or make an attempt to do so, and we're up here, where should the price draw to? Down. Where can it turn to start going down? Well, you have to know your PD arrays. Initial high, that's the opening range high. If it goes above that and spikes through it, it could have went up there and hit that wick of the high on the daily chart. It never traded there. So because it failed to get there on this initial run, here's the opening bell, runs up, next candle slightly higher, and starts going back down. Where is it going back below? The rejection block right there on the daily chart. That's the highest up close in that price swing on the daily chart. We failed to get to consequent encroachment of that wick. Is that bullish or bearish? When we have an opening gap, that's a premium. In other words, we had all of this, but this opening and rally up and then going right back down below the low and below that rejection block, we couldn't get to the consequent encroachment of that wick. I can't even reach up here for your ICT, so start looking lower. Well, let's wait for the market to do what? Give us the mid gap. Well, it does that. There goes the whole 70% of the time. It was one more time giving you the proof of it. In this leg here, and it starts to rally back up, it goes right above the rejection block. That is a turtle soup. Now, we're sell side, right below the initial low. That low also is just a little bounce off of the old volume imbalance. So the sell side below here is going to draw to that. I said the very first fair value gap that forms between 930 and 10 is your very first fair value gap that actually runs up into a rejection block with an opening range that has not completely closed in. We did get the halfway of the gap delivered, offering what? Opportunity to see if it can retrace and go lower. When we were trading here, I said, okay, we're at the top of the opening range gap. Once it trades above, it forces, if we trade below here, it will be a full gap closure. So you're watching price here. First fair value gap formed. Now, if that's your fair value gap and we went back below the opening range gap high, as soon as we do that, that is indicative of what? Seeking that where the sell side is. And if it's going to go there, it's going to be a full gap closure. If I was short, I would take partials just above the full gap closure. Why? Because sometimes the gap won't fully close and then you can see it run and take out the relative equal highs. If it goes back into the range, it's going to go here. If it's going to go here, it's going to be a gap closure event. So how will we use that fair value gap if that narrative and logic is in play? Wait for it to trade down below it, then trade back up into it. Then how would you want to see price deliver if it takes out that low? If it goes below that low, the style and the characteristic of that delivery should be sudden. It should be quick. I don't know, does that look like it's sudden and quick on your chart? And here's the SIBI high. So we traveled all the way down to the lower quadrant with the bodies of that old volume imbalance. You can see that's the volume imbalance. And if we anchor a fib to that, you always want to do this on the time frame that the imbalances are forming. So then we have one with our quadrants, the midpoint or consequent encroachment and the lower quadrant and upper quadrant. This candle's low right here, the down close one with the long discount wick. That right there, that low is the high of this SIBI, all this one singular candle to that. So in other words, you would see it like this labeled if I was showing it to you with a naked chart. So we're seeing the high of that. So since price is above it and we're coming back down, that old array is what kind of array? It's a discount. Price is going to draw to it. It can draw down to it, go through it, and come back up and treat it as what? A premium array. That's how you work through the PD array matrix. Here we have the quadrants. Disregard this new day opening gap for a moment. We have the high of that shaded volume imbalance on the daily chart. This is the upper quadrant to it. Midpoint is this. There's consequent encroachment. It's red. Then you have the lower quadrant level, and you have the low of it. We traded down. We created a fair value gap right there, and just above a new day opening gap for today. So what does that mean when we're down here? We can go above it. How far? Fill in the fair value gap. I like that because it's laying right on top of the upper quadrant. Are we looking at just a closing of a fair value gap? No. So if we have this fair value gap and a new day opening gap, we know that it can sweep above it. It need not just trade to it and drop down. No, that's not how it works. Where's the inefficiency? Right there. Do we have something in agreement with it? Just not by a fair value gap alone. What else is in close proximity to it? Inside that volume imbalance, that shaded area, the upper quadrant level is there. Where does it trade to? Boom. And then what does it do? Low, low, low higher than that low. So what's below that? Sell side. Fair value gap closed? Yes. Bodies nowhere near closing on them, on that level. And where does it go? Sell side. That might be your silver bullet. Let's say you saw this gap and let's say you bought it. And say you say, okay, I'm going to try to buy this. And then it goes down and stops you out. Wonderful. That's a wonderful opportunity because then, because of the rules I just gave you, you know that we have a real strong chance that we're going to take this low out. And if it does, then we have even higher probability than the 70% that when we gap higher at the open, that the midpoint gap will be traded to between 9:30 and 10 o'clock. If it takes out that low, we have a 80% chance that it's going to have a 3/4 closure on the opening gap, opening range gap. So that means we're about right in here. So what happens when we start to rally back up and we see that inversion fair value gap? You already see it failed with your usage of you trying to buy it. And now it's tipped its hand to you. So what are you going to do? You're going to say, okay, well, we went below it now. And the rules state that we went down half of the gap, we hit that and we rallied, but then we failed at the fair value gap. The very first fair value gap between 9:30 and 10 o'clock. If this goes below here, it's going to go back to 3/4, and then you wait to see if it gives you a full closure of the gap. And if it takes out the gap to the downside, which is what it does here, it trades below the low of the gap. Where's it going to trade to next? Well, in this leg here, is there any inefficiency? Fair value gap. Your eyes should jump right to it. What else is there? You can't just have that alone. Support it something else. Upper quadrant of the volume imbalance. So they have two things. So where's the liquidity at? If you're going to sell short in there, where's the liquidity? Where's the inefficiency first? Well, you have it right there. But that's not enough to get excited about. So if that's all you saw and you didn't factor liquidity below the lows, that wouldn't be a trade you would take on. But you have a low that's slightly higher than that one. It's too smooth. It needs to be made what? Jagged. Sell short, engage the sell side, be done. Because you've had now 1, 2, 3 legs lower seeking liquidity on the downside. So we've pressed 3 times into sell side. The market is entering. We're getting close to when the market can have a retracement into opposing liquidity. So we've seen sell off and no buy side except for this one has been engaged in this. But we had 3 deliveries into sell side. So it's setting up a potential where we can get a intraday retracement. Even if it wants to keep going lower, it's fine. But you have to measure every single time we engage liquidity. If 3 times we go into sell side or 3 times we attack 3 successive higher levels of buy side or 3 successive lowers of sell side, it opens and invites the opportunity for a retracement, for intermediate term retracement. It doesn't mean that you called the low of the day. It doesn't mean it's calling the high of the day. It just means that you need to be aware that you've done this now 3 times intraday. So it can spool the other direction. And many times that sets up a wonderful continuation to go even lower or even go higher. But you have to anticipate that because once you get that, you're setting the stage for an intermediate term retracement. Or it could be a complete reversal. If it has this very first fair value gap here and we trade below it, what's your mindset going to be? Switch to inversion. Wonderful. First threshold is where's the midpoint? That's here. Consequent encroachment. If it's a valid inversion fair value gap, will it completely overlap? In other words, will it go below it and come all the way back up and touch the high of the old gap? No. You want to see it fail to close that in as it goes back up. It's leaving a portion of that candle's low and that candle's high. In other words, it looks like this. That's the portion that didn't close in. We had the market reach up into this inversion fair value gap. It's the first gap inside of 9:30, 10 o'clock. Hits it, leaves it open, drops. Next candle, open, trades up, rejection block, highest up close in that price swing. Just enough to bump it. There. That's algorithmic. Drops aggressively. When you see it trade up in the inversion fair value gap, that's your proper use of the very first fair value gap. It's changing the state of delivery, just like an order block will. Order block, we don't want to see it go, and when it's a bearish order block, we don't want to see it trade above mean threshold. We want to see it dig up into it and roll over and go lower. Reverse it for bullish order blocks. We do not want to see it go below half of its range. Why? Because the strength is indicated by its inability to get to the furthest extreme. A perfect redelivery would be this candle or any other candle trading up into and touching the equivalent low of that candle right there, which would be 19,979.25. As we have this, we have 19,977.75. So we fell short of that, right? To the tune of the range between that candle's high and that candle's low. That's exactly what you want to see, which is the confidence factor that was given to me when we were down in here. That would be Caleb's entry. That's his model. Rejection at the rejection block. Trades lower, below the gap. Caleb's school of thought will be, I want to see this gap be overtaken to the downside and then offer me an opportunity to get short. At what price? He will use this candle's high, 19,973.75 minus one tick. That would be what? 19,973.5. That means all it has to do is book that high. The rejection block, we trade above that. We did get the midpoint of the gap. So if we go above the opening range gap here and then come back in, the net low is going to be suspect. So if it's going to take that low out, then we go to 3/4 gap closure and then full gap closure. We also had new day opening gap high and low inside of the opening range gap, that blue shaded area. So he would take that trade based on that logic. His stop would have to be above consequent encroachment of this wick. Why not the high of that? Because we already had this low, we dropped down, immediate rebalance, then it drops. So for someone that is a little bit more scared, you could use the high. That's fine. He's going to have this as another frame of reference. He can use the midpoint of that wick and just a tick above that, because it's not going to go back up there. If it were to stop him out right there, then I would use this level here to instruct him to go long. Then it would be reclaimed bullish fair value gap. To get to that midpoint here on that wick changes the whole classification of this being an inversion fair value gap. If we wouldn't have had this immediate rebalance, then his stop would have to be above there. If we get short on that idea, his partials would be here if he has multiple, but he can't, so he has to annotate that. His next one would be 3/4 gap closure. Selling short here. Below that low, what would be the next threshold to reach for? It would be the 3/4 of the range that makes that opening range gap. So that could be your partial. The next would be the new day opening gap high, or somewhere in the vicinity between its low and high. And then if it has been enough time for him to build his equity up and he has 1.5 times full margin, each time he can meet that threshold, he can trade one more contract. That means he cannot over leverage. It's impossible for him to over leverage. He can only take one trade a day. If he loses, he's done. If he makes money, he's done. Dad is calling the shots. You probably never looked at your trading like that, where you were holding yourself very rigid, saying, I can't let myself do this. You want to be able to be flexible with rules and say, well, ICT said this, but I'm going to do it. For continuation, he can then wait to see if we can get below the new day opening gap, which is what we see here, and then wait for what? A retracement. We have a fair value gap and upper quadrant agreeing with this fair value gap. So we're sweeping above. See, we're sweeping above the new day opening gap. Isn't that what I taught when I started teaching in these lectures? You want to give the algorithm a chance to move around these levels, because there's going to be stops and liquidity, or it will entice traders to chase it. So this type of movement here causes traders to do what? They want to chase it. And if they think they understand fair value gaps, what are they going to do on this little thing right here? They're going to try to buy that right there. We have that old volume imbalance. Key levels: upper quadrant, consequent encroachment, which is this red line here, lower quadrant, and then the low of it. New day opening gap. We want to see it do what? Sweep above it and then provide a means of going short. How can we key off of that? Fair value gap, 3/4, sweeps above. We're in a premium. Where's it go? Sell side, drops down. What is this? Sell side imbalance, buy side inefficiency. So would you look at this frame of reference right here, annotating that low to that high and extend that out in time? Would you do that? You would if you didn't know how to do fair value gaps properly. What is this? Inversion fair value gap. You're going to see buy side imbalance, sell side inefficiency here. When you're in a market that's going lower, you want to see buy side imbalance, sell side inefficiencies be used as future inversion fair value gaps. So if you know this logic, you can then, once you wait for them to form, you extend them forward. When they agree with another reference point, something else, it cannot be one singular PD array. Minimum 2. 3, you got a lead pipe cinch trade then. What's this red line right here? Consequent encroachment of the old daily volume imbalance. What's it touching right there? That level. That's also part of this inversion fair value gap. The market sells off. Short term sell side, minor sell side. We have this low, all part of August 20th new day opening gap, and we have this low. So we have 1, 2, 3 levels that retail is going to see that as what? Technically, they're going to view that as a support level. I don't see that as a support level, okay? Like a barrier to breach. We're getting a little close to lunchtime macro, so I would like to see it, if it's going to do it quickly. And then we can attack the new day opening gap here in this high. If it takes that low out, I would like to see that run for the lunch macro. Lunch macro, again, market tends to retrace against the underlying direction that has transpired that morning session. Obviously, I think everyone can agree that it's been dropping since this morning. So this morning we've had trailed stop losses. And then what you want to do is if we take these lows out and then the lunch macro starts between 11:30 and ends at 1:30. It does not mean there has to be a retracement. You want to look for the opportunity for it to happen. What you do is you at that time at 11:30, if you see something that is potentially setting up the retracement for the lunch macro, the algorithm will start running to opposing liquidity. This high, if we go below us, this will be the first high you get to that has to be post 10 o'clock. So here's 10 o'clock. So you would use that as a beginning point. Go to the right and every high, here that one, but then we made this high and then we made this high. So I would use this high as the lunch macro. That's where the market would draw. It does not mean that at 11:30, it's just going to start going up and go right to that level. There's other things that you have to factor in. There's the rundown we were talking about, running those relative equal lows. It's just like every time I say something, what I'm interested in, does it accelerate after taking a next candle, bump the low, or maybe consequent correction on the new day opening gap, and then run that low right there. But look at the reaction off of this gap here. Look now, if it's going to go that far, look at the next new day opening gap down here at August 21st. What's the chances it can at least tap into that? Just for shits and giggles. Can it do it? But the fair value gap here is also a rejection block. See that up close candle? And what? The low of that daily volume imbalance. I'd like to see it stab down there and hit that new day opening gap on August 21st. I'd like to see that go boom real quick and be done. Midnight, Wednesday. Then we cross over to Thursday. Prices trading where? Relative equal lows. But the level is the old daily sell side imbalance, buy side inefficiency high. When I took you on the daily chart, remember it was that red box that said if I was going to highlight it, it would be looking like this. That's what it's doing. So when price is above it, how's it going to treat that level? As a discount level. Sweep. What's the body's telling you? It ain't even touching it. What's the body's telling you? It ain't even touching it, but it's a higher low. The market rallies back up. What is it doing in this area? Where is it at? It's inside that old daily volume imbalance. Over here, what is this? Relative equal highs. What's resting above those relative equal highs? Buy side or buy stops. It's traded down to a discount level or PD array in the form of the daily sell side imbalance, buy side efficiency high. That is a PD array. So when you are expecting higher prices, which we've been calling, we have not been trying to pick the top. The market trades down outside of the volume imbalance. So where could it trade to? The next PD array on the daily chart was that high of that SIBI. It trades to it here, then moves back inside of the volume imbalance. Inefficiency on the upside after poking its toe outside of the yellow area, which is the volume imbalance. This fair value gap forming when? It's 1 minute past the opening range at midnight. You did say if I want to trade in London, that reference point there from midnight to 12:30, that's your opening range. First presentation. What is that? First presentation is when you have time of day and first presentation. That means the first inefficiency. You want to take that and cast it forward throughout the entirety of the day. It uses it here and touches it right there. It drops right into that. Here we have 1:50 a.m. all the way over to 2:10 a.m. But this is a macro. It's the first one you're going to get to as you enter into London open kill zone, 2 o'clock to 4 o'clock. That's your sweet spot. Then we see it touch that fair value gap, which is first presentation inside of the range of the first 30 minutes, 12 o'clock to 12:30 a.m. Does it react off of it? Yep. Creates another fair value gap, which is also part of what? What do you see here? Here, here, here. Bullish breaker. So even if you don't see this fair value gap, it's fine because you'll get the breaker there. Drops once more. What is this little indicator telling me right here? 350 to 410. I'm going to ask you a question. Does the market respect that fair value gap here? And does it respect it here? Does it send price higher? What time are these setups forming? The macro times that I said. So you're seeing lower quadrant of the old daily volume imbalance, lower quadrant, consequent encroachment, fair value gap, time. What time is the setup going to form? Where to trade to? Let's go into yesterday and with the right volume imbalance. So we have the volume imbalance here and I have the quadrant level. But I was watching price yesterday and we did trade up into the volume imbalance, lower half of it, but didn't quite get into the second half. And we had this big dump off here, and it rallied once more. And as we dropped down in, I was watching that new day opening gap on the 20th. I'm thinking to myself, hey, if they can send us on a closing basis below these lows on here, then I'm going to use any return back up into that new day opening gap, hit that, use it as a sell-off, and go lower. And I was going to aim for this low here. This is part of a breaker there. This high, this low, two forms of what? Discount array. I want to see, does it want to go and close below here? And it didn't do it. And as I was watching it, I was looking at this fair value gap. Because I'm using a 1 minute chart, and because I'm trying to annotate it while I was recording it for you, I highlight this area here, and I don't get a chance to throw the rectangle on this candle's low and this candle's high. It's a little off. Look at the recording, you'll see it's not anchored properly. And because I see that we're now dipping in here, I'm like, okay, I want to catch it on a buy stop. So I go in and I put in a order to buy it as it clears and should breach the consequent encroachment. I want to be in it should it do that. So I heard him and do something like that when it's trading here. So if it's going to go, and if this really is an inversion fair value gap, it's going to be treated as like a springboard. I want to get in there on a stop as it proves it's going up. That way, what it's doing is if it just drops out of it and goes lower and attacks these relative equal lows, I won't be filled. I'm buying the strength that the inversion fair value gap should prove to me with delivery of price because it's already wicked outside of it. See that? So in here, running up, and then we're back down in here in this consolidation. Which side would you bet on? Going to relative equal lows or the relative equal highs, but into the area that was not delivered yet on that old daily volume imbalance? I wanted to be a buyer on the upper half of that inversion fair value gap because I saw this candlestick here and I didn't readily see it, but because I missed it, I have to now look at this gap that's now here at that candle's close right there. I'm noticing it as I'm looking into this candle and I'm like, shit, I have two options here. Fix the fair value gap and have it anchored like I have it here, or just go in and just get the fill. So my mind said, if it's going to go, I want to do it on a buy stop. So it means it's got to trade up to my level like a buy stop would be used to protect a short position. That's the entry mechanism I used. And I was doing it inside of this inversion fair value gap. So in other words, I wasn't looking at it as like it was going to go up here to go down. Initially, I was looking for reasons to try to maybe suggest that it may do that and then catch a smaller immediate rebalance or a fair value gap on a 15-second chart after it respected it. But when I looked at the candle, I was like, oh shit, actually, I'm reading that wrong. I'm going to go in there and treat it as an inversion fair value gap. So I couldn't get it drawn out properly. I went in buying. Look where the little caret that appears when you highlight your little buys and sells. When you hover over top your arrows, if it's going to go to that level, I'm probably going to be on side, and it would have to be drive up into this here. Once it takes that high out, I'm watching this wick. I want to see it trade above consequent encroachment of that wick. And then I wanted to, and you can see me, I'm doing the fib on this, and if this thing's like, it's Elvis has left the fucking building. It's gone. It's taken off. Well, I knew at that time I was going to get another pyramiding opportunity, so I just had to work with it. And because it was happening so fast, my mind said, well, what do you want to do here? Do you want to take half off? Do you want to take 2 off? Do you want to take 4 of the 6? What do you want to do here? So I was like, well, fuck it. I'll peel off 4 here. And I was trying to time it right when it touched the upper quadrant level there. So I took that off there. And then finally the limit order fills, and it fills at the high end of the volume imbalance here. All this move here I was not able to be a participant in. I didn't capture any of that move clearly. And this was too fast. It literally was too fast. I was setting this recording up to make the video to go on YouTube when this was happening. So, okay, I waited. As we traded up, look what the high of this candle is. And the lower quadrant level is here. It's not touching it, is it? Is that wick on there touching it? Nope. So what does it do? It trades down. What's an ICT order block? It's a change in the state of delivery. I'm going to put the execution back on again. We do not hit it there. And then this candle does what? Comes all the way back down and crosses over that candle's opening price. That is when the algorithm changes. Now we're going lower. We've done the delivery to the buy side, trading right back up into what? The old daily volume imbalance. It's using that same PD array. Trading up into that. And then I'm waiting for the price to do this. Cross that opening price. Once it does that, these 2 consecutive candles is my order block. So he can see me call something, And then several minutes later on, he watches the candles form. So he has the benefit of knowing that dad said this. Now I'm waiting for the chart to present that. And then I'm going to watch it as it's happening. That's how you should be using these live streams. When you're watching the recordings, do the same thing. Even if you watch it later on, you can't watch it live or whatever. Rewind and keep rewinding that spot that I'm talking about something about price, and then you watch the candles, because I'm looking at a 1 minute chart. That's a very, very low time frame. You don't need the less than 1 minute. 1 minute's going to give you a lot of details, but you're watching the fluctuations of every one of these individual candles. So when we traded back up into that volume bounce low after this big drop off, where price is doing this, is it more likely that they're going to come back down and sweep below the sell side here when we trade at this level, or continue up and take out that high? Clearly, it's going to be exploring the downside, because we've been going up for a long time and we finally worked our way to and through that daily volume imbalance. So it's exhaustive, pumped it up there real hard and allowed a heavy measure of distribution come in the marketplace. I knew this. And watching the market trade back up into the low of the volume imbalance, then I wanted to see, does my order block give me my signature of when it's going to be good to sell short? Up close candles, your consecutive, opening price, that's your change in state of delivery. Right there gives it to me. It does not require a close below. In this case, when they're consecutive, all of this is the entire order block. But your eye goes to the opening price, the lowest opening price of the consecutive candles. In this case, it's this. When it takes that out there, all it does is have to breach it. That means trade to it and below it, one tick. That activates that right there. And my eye goes right to that, because everything going forward, the algorithm is going to refer back to that same price. We have the opening price here, and this candlestick crosses over it. Right there at that point, as of 11:16, we are now in a sell model. This candle, we open right at the low of the volume imbalance. We open, trade up a little bit, come right back down. Next candle, opening, rallies back up. Does it take the rejection block there? Because if it takes the rejection block, that nullifies the order block. It completely undermines it, says, nope, don't do it. If I have a trade open, I will kill it. And then right here, we cross back down. In here, we do not get the rejection block. And as it was forming lower, as I'm aiming right towards the low of that, I'm getting two things at one time. Failure to get the rejection block, because it should have did it spike right up in it, bang and done. Because if this is a valid order block, it should not go there. And I'm waiting for that. I want to see it. Okay, it's wonderful. Drop. Right there's my fill. I'm eyeballing it, marketing in, and I'm trying to aim it as it's hitting where the body is starting to drop down. I'm trying to aim at it as it's hitting the low of the volume imbalance. That shaded yellow area. That's the same section on the daily chart where there's a section where there's no bodies that overlap or connect. It's just the wicks. Then we close here below that price. Every time we hit that, does it support lower high? Yep. Lower? Yep. Only going back up into this candlestick here, sell off. I'm adding into the low of the new day opening gap on the 20th, right here. Oh, but look at this. You had a little bit of retracement. Right. My larger position's up here, 6. I'm not underwater. It never goes into a negative. It never. Do the math on it. That's why I go in with the higher portion, larger first, and then I can pyramid down here. Market breaks lower, comes one more time. What is it hitting here? That's the daily SIBI high. It's it here, here. What's this? Rejection block. Sells off. What's below here? Sell side. What's these levels here? New day opening gap. When do you get that information? 6 p.m. on the 20th. I'm aiming for sell side below here, and I'm trying to reach below, take the sell side out below here. How do I get to that level? How do I get to these prices? Here's a consolidation. I want 1/2 of that consolidation out. That's a standard deviation. That's a pretty good place to take profits, isn't it? As it's aiming in, hitting it, I'm trying to get out with the sell side. So I went long based on experience, and I knew that it pulled some shenanigans is basically what it is. I knew this was manual intervention. I knew they were going to gun the high. I knew they were going to probably take it up to the high of the volume imbalance. I knew that much. And then it was a little overzealous on the upside. So I was right about picking the time when they were intervening. I am not able to do this consistently, but there are few times, and I mean this very, very few times, when the markets are conducive for having these seek and destroy events, which the characteristic of this week is what I told you on Monday in our live stream. I said, be aware that we have Jackson Hole Symposium. So if you look at the economic calendar, you'll see it looks like this. Anytime going in the future as a trader, when you see that the economic calendar has that on it, you're going to have delivery of price that will overlap back and forth. And it can invite the conditions that is seek and destroy. If you don't take partials, you're going to give up the best wins and you'll overstay your welcome. I proved this yesterday by having a trade on and telling my students what I was looking for. I wanted a little bit more overzealous target, and it finally came back and took me out of what I was aiming for. I don't think that a Jackson Hole Symposium week is a week that you should push real hard on, because it takes a lot of experience to find a good setup and not get overlapped. That means like when you see a price run where it goes like this, it runs up, comes back down, doesn't take the low out, and runs right back over top of it. You want to try to do your trading at the beginning of the week. And if you're going to do anything in the latter part of the week, you want to be very, very light-handed and not have a lot of leverage on. And don't trade a lot. Get one good setup, be content with that, and paper trade the rest of the time. There's nothing wrong with that. Now, if Jackson Hole Symposium starts on a Monday, or any one of those 3 days of that symposium is on a Monday, you don't trade a Monday. Absolutely don't trade it. So I went long, and then later in the afternoon, I went short. 6 contracts or so I came out, and then I got stopped out on the bounce of here. So I covered 5 and one more, and then the trailed stop loss. I was giving it room to see if it can overlap a little bit of this. I was hoping that the new day opening gap would keep it at bay, and then finally it stopped me out right there. Now, this one was something I was sharing with my private students to kind of like anchor, because they're part of a community that is beyond what this is. I was teaching them early in the beginning of the week, also telling them that just be mindful that this week we will see overlapping price. That means it'll go back and forth, and whatever price run was before the one we're in now, it's going to go over top of that and run potentially whatever stop was there. So I did something that made sense technically, shorted at a really good level based on sound logic, added to it based on sound logic, good risk management, no over leveraging, targeted liquidity, majority lion's portion of the move taken below old lows where smart money traders are going to distribute their short positions. And then I allowed the market to come all the way back up. Now, truth be told, I wanted to see it come down here, and I was going to start doing partials right into here. I would took one off of the remaining 4, and I would have took one more off below these lows here, and I would have took one off here, and then I would have had one contract remaining to see if I can get below here and then reach for the target I had. That's how I intended to trade it, but it came all the way back and got the balance of the 4 contracts of the 10 that I went short here, 6, added 4 more here. That is the closure, and then that's the closure right there. Buying it long, I would have shorted it here had I been in front of the charts, but it was too fast for me, way too fast. I was thinking I was going to be able to upload the video because it was real short. I compressed it real quick. And I came back to the charts, and I was expecting to do something in the upper half of the volume imbalance to get short on. And it just said, oh, hell no, lower. And then I had to wait for this objective here, which is fine, because I would have wanted to short up in this area and then use the lower end to pyramid. I would have done 6 in here. If it would offer me something on the high end above the midpoint, was that red line, if it would have gave me another fair value gap to trade into or institutional order flow entry drill, I would have went short on that. Or if it would have traded back up into this wick, half consequent encroachment, I would have added there. And then as it broke lower, the last pyramid entry would have been trading what I have here. If it would have given it. It may not have given it though. But that's my thought process.